Welcome back. I am your host, a financial crime certified professional with 20 years of experience across international banking. In this video, we are going to break down Domain A of the Certified AML Specialist exam. This is the domain covering risks and methods of financial crime. It carries 30% of the total exam weight, and it is one of the two most important domains you will face on exam day. We will go through every major topic the official Certified AML Specialist Handbook covers in this domain. Money laundering stages, predicate crimes, high-risk sectors, crypto assets, gatekeepers, and exactly how to study for it. Stay with me. By the end of this video, you will have a structured, complete understanding of Domain A that will hold up on exam day. This video is brought to you by AdviseCube Consulting. If you want to practice Domain A with 1,700 exam-style questions, concise study notes, and a full e-learning course with an AI bot trained on certified AML specialist material, all available 24 hours a day, visit advisecubeconsulting.com or message us on WhatsApp. Let's start with a fact that most candidates underestimate. Domain A, risks and methods of financial crime, carries 30% of the total exam weight. That means 36 of your 120 questions come directly from this domain alone. The only other domain at the same level is Domain C, which also sits at 30%. Now here is what surprises many candidates. Domain A feels conceptual. It feels like background reading, money laundering theory, crime types, sector risks, and because it feels like context rather than compliance, people underprepare it. That is a serious mistake. The exam does not test your ability to define money laundering. It tests whether you can apply these concepts to real scenarios. It asks you, given this situation, this customer, this product, this transaction, what are the risks? Where is the vulnerability? What should you do? Getting Domain A right can push you comfortably past the 75% passing threshold. Getting it wrong will follow you across the rest of the paper. Domain A does not just cover money laundering. It covers the full spectrum of financial crime, and you need to understand all 6 categories. AML, anti-money laundering. This is the core. Converting the proceeds of criminal activity into assets that appear legitimate. We cover this in detail in a moment. CFT, countering terrorist financing. Different from money laundering. The amounts can be small. The funds can come from legitimate sources. The purpose is destruction, not concealment of profit. Sanctions evasion. Circumventing restrictions imposed by the UN, OFAC, the EU, or national regulators on specific individuals, entities, or entire jurisdictions. Fraud and corruption. Deception, theft, bribery, and abuse of position. Fraud is often the predicate offense that generates the proceeds that are then laundered. Anti-bribery and corruption, ABC. Governed by frameworks like the FCPA in the United States and the UK Bribery Act. Politically exposed persons, PEPs, are high risk in this category. Tax evasion, the illegal concealment of income or assets from tax authorities. Globally recognized as a predicate offense and increasingly linked to AML obligations. You must know these 6. And you must understand how they interconnect, because in practice, they rarely occur in isolation. Now to the foundation of everything in Domain A, the 3-stage model of money laundering: placement, layering, integration. Every AML question, whether in the exam or in real life, maps back to one of these 3 stages. Stage 1, placement. This is the point at which criminal cash enters the financial system. It is the most vulnerable and most detectable stage. The criminal must physically move large amounts of dirty money, usually cash, and get it into a financial institution or vehicle. Methods include depositing through cash-intensive businesses like restaurants or car washes, structuring deposits below reporting thresholds, known as smurfing, currency exchanges, and substituting gambling winnings. The risk is high at this stage because cash is visible. Banks and regulators are watching. Stage 2. Layering. Placement got the money in. Now the goal is to make it disappear from view. Layering involves creating multiple complex transactions designed to obscure the audit trail. Methods include wire transfers through multiple jurisdictions, transactions through shell companies, trade-based money laundering, where goods are over or under-invoiced, and in the modern context, cryptocurrency mixing and chain hopping. This is the most complex stage. It is hardest to detect in real time and hardest to unravel after the fact. Stage 3. Integration. The money has been cleaned. Now it re-enters the legitimate economy as seemingly lawful wealth. Common vehicles include real estate purchases, luxury goods, business investments, and the loan-back scheme, where a criminal borrows back their own laundered funds with interest payments to further legitimize the flow. Hardest to prosecute. The money looks clean. Only the pattern of behavior gives it away. Money laundering cannot exist without a predicate crime. The predicate offense is the underlying criminal act that generated the proceeds in the first place. No proceeds, no laundering. FATF, the Financial Action Task Force, has designated specific categories of predicate offenses that member countries are expected to criminalize. These include drug trafficking, human trafficking and smuggling, arms trafficking, terrorism and terrorist financing, corruption and bribery, counterfeiting, and piracy. Beyond the FATF categories, the exam also covers financial and economic crime predicates: fraud, embezzlement, insider trading, market manipulation, tax evasion, and cybercrime. Organized crime predicates include racketeering, extortion, kidnapping for ransom, illegal gambling, and environmental crime, which has grown significantly in FATF guidance. For the exam, know the FATF designated categories. Understand that predicate offenses generate the proceeds, and be able to identify which crime type is the source in a given scenario. The handbook analyses financial crime across 4 dimensions: sectors, products, customers, and channels. This is the framework you need when reading a case question. Sectors: banking, real estate, gaming, precious metals, professional services like law and accounting, MSBs, and remittance. Each sector carries distinct vulnerabilities. Products: correspondent banking, private banking, shell company accounts, trade finance instruments, cryptocurrency, insurance and investment products. High-risk products often share features. They are complex, cross-border, and involve third parties. Customers: PEPs, beneficial owners who are obscured, cash-intensive businesses, high-net-worth individuals, non-resident clients, customers located in high-risk or sanctioned jurisdictions. Channels: cross-border wire transfers, structuring, offshore accounts, digital and mobile payments, cryptocurrencies and decentralized finance, trade-based transactions. Channels determine speed, traceability, and regulatory coverage. When you encounter a scenario question, apply this 4-dimension lens. What sector is this? What product is being used? Who is the customer? What channel is involved? That analysis will lead you to the right answer. Banks are the primary target of financial criminals and the primary gatekeepers of the financial system. The handbook dedicates significant attention to bank-specific risks. High-risk products. Correspondent banking, where one bank provides services to another bank, is one of the highest risk relationships in the entire financial system. You are effectively accepting another institution's customer due diligence. The same applies to payable through accounts and concentration accounts. Private banking is another critical area. High net worth clients, large transactions, relationship-driven service, and often significant pressure not to ask too many questions. Loan-back schemes are exam favorites. The criminal places proceeds, the bank issues a loan against those proceeds, and the loan repayment creates a clean paper trail. The original dirty money never appears in the narrative. PEPs, politically exposed persons. This topic appears frequently in Domain A questions. Know the distinction precisely. Foreign PEPs are always high risk, no exception. Domestic PEPs can also be high risk, depending on their role and jurisdiction. Family members and close associates of PEPs are included within the definition. The obligations are clear. Enhanced due diligence is required. Source of wealth must be verified, not just source of funds. And the relationship requires ongoing monitoring, not just a one-time check at onboarding. PEP questions often test whether you understand that the enhanced obligations continue throughout the relationship, not just at the start. Non-bank financial intermediaries are a major focus in Domain A. They handle enormous volumes of transactions, often cross-border, often at speed, and their compliance maturity varies significantly. Money services businesses. MSBs include currency exchange houses, money transfer and remittance operators, check cashing services, issuers of money orders and traveler's checks, and prepaid card distributors. They are typically licensed, but licensing does not equal robust compliance. MSBs often operate with high transaction velocity, low individual transaction values, and limited customer identification, which makes them attractive for placement and structuring. They are also frequently used as layering intermediaries, particularly in cross-border remittance chains. Payment service providers and e-commerce. Third-party payment processors, digital wallet providers, e-commerce marketplaces, buy now, pay later platforms, and peer-to-peer payment applications all fall into this category. The risks are high transaction volumes that are difficult to monitor individually, geographic mismatches between the platform's jurisdiction and the customer's location, and the speed of modern payments that outpaces traditional monitoring systems. For the exam, understand that the absence of a bank in the transaction chain does not reduce AML obligations, it shifts them. Virtual assets and cryptocurrency are now firmly embedded in Domain A. Do not treat this as optional study material. It is tested. Virtual Asset Service Providers. A VASP, Virtual Asset Service Provider, is any entity that conducts exchange, transfer, safekeeping, or administration of virtual assets on behalf of another person. This includes centralized and decentralized exchanges, custodial wallet providers, and certain token issuers. Under FATF Recommendation 15, VASPs are subject to the same AML and KYC obligations as traditional financial institutions. They must register or license with their national authority and implement a full risk-based approach. Crypto-specific typologies. The exam expects you to recognize these typologies. Mixing and tumbling services that deliberately break the transaction chain. Chain hopping, where funds are converted between cryptocurrencies to obscure the trail. Unregulated peer-to-peer exchanges. Privacy coins like Monero and Zcash that offer enhanced anonymity. NFT wash trading, and exploitation of DeFi protocols. The FATF Travel Rule. This is high priority. The Travel Rule requires VASPs to pass originator and beneficiary information with any virtual asset transfer of $1,000 or euros or more. The originating VASP must send the originator's name, account number or wallet address, and physical address or national identity number. The beneficiary VASP must receive this information and verify it. The travel rule for VASPs mirrors the wire transfer rule for banks. Know both. Non-compliance with the travel rule is treated as a critical gap by FATF assessors. It will appear in exam scenarios. Real estate. Real estate is one of the most widely used integration vehicles globally. All cash purchases are the primary method. There is no bank, no KYC, no transaction monitoring. Shell companies and nominee purchasers are used to obscure the beneficial owner. Trade-based money laundering can also occur through property over and under valuation. The key exam question in a real estate scenario: who is the buyer and who actually owns the buying entity? Gaming and casinos. The classic placement mechanism: cash in, chips purchased, chips cashed out. The casino receipt provides a clean paper trail. Third-party chip purchases, online gaming platforms, and high-roller account management add layers of complexity. Know the red flags. Insurance and investment products. The risk is in the product life cycle. A criminal buys a single premium policy with cash, placement, borrows against it, layering, surrenders it early and receives a refund, integration, now looking like an insurance payout. Overpayment and refund requests are another red flag worth noting. Exam focus. Understand the full life cycle from purchase to surrender. Gatekeepers. DNFBPs. Designated non-financial businesses and professions. DNFBPs include lawyers, accountants, notaries, real estate agents, and dealers in high-value goods. FATF requires them to apply AML measures, conduct customer due diligence, and file suspicious transaction reports when suspicion arises. Lawyers present a specific challenge. Professional privilege is sometimes invoked to avoid disclosure. FATF is explicit that privilege does not override SAR obligations where a lawyer is facilitating, not merely advising on, financial crime. Corporate structures are one of the most effective tools for concealing beneficial ownership. The exam tests your ability to look through the legal form and identify who actually owns and controls an asset. Trusts. A trust involves three parties: the settlor who establishes it, the trustee who manages it, and the beneficiary who receives the benefit. In a money laundering context, a trust can separate legal ownership from beneficial ownership almost completely. If the trustee is a nominee and the settlor is a criminal, the beneficial owner is effectively invisible unless enhanced due diligence is applied. Shell companies and company service providers. Shell companies have no operating substance, no employees, no offices, no real activity. They exist to hold assets, move money, or sign contracts on behalf of their hidden owner. Company service providers, CSPs, form these companies on behalf of clients, provide nominee directors and shareholders, and maintain registered offices. They are themselves DNFBPs subject to AML obligations under FATF Recommendation 22. The layering pattern is well established. Criminal funds pass through multiple shell companies in multiple jurisdictions, each owned by another entity until the original source is undetectable. Accountants and other gatekeepers. Accountants, notaries, and legal professionals provide professional legitimacy. They are not always complicit, they can be unwitting participants. But when they do facilitate financial crime, the damage is significant because they provide cover that a sophisticated investigator must work hard to penetrate. The exam question is always the same. Is this professional a facilitator or an unwitting participant? Your answer should be based on red flags, due diligence failures, and whether they had reason to know. You now have the content. Let me give you the study structure that will actually convert this into exam performance. Phase 1. Read the handbook. Read the Domain A chapters end to end, not just summaries or bullet points. Mark every money laundering typology you encounter. Understand the reasoning behind each risk classification, not just what the risk is, but why it exists. Do not skip the FATF context. FATF recommendations and designated categories underpin almost every Domain A question. If you do not understand why something is regulated, you will not be able to apply it under pressure. Phase 2. Apply to scenarios. For every typology in the handbook, build a real-world scenario in your head. A cash-intensive business, What sector? What product? What customer? What channel? A VASP transaction without travel rule compliance. Where is the breakdown? Train yourself to reason through exam questions rather than recall answers. Memorization will fail you on multi-select questions. Reasoning will not. Phase 3. Practice Domain A questions. Do not rely on mixed question sets. Target Domain A specifically. Review every wrong answer and understand why you got it wrong, not just what the right answer is. Practice multiple selection questions. These are harder than single answer questions and are heavily weighted in the actual exam. Track which subtopics, PEPs, VASPs, MSBs, Gatekeepers, you get consistently wrong and revisit them weekly until they are solid.
Before we close, I want to tell you about the resources we have built at AdviseCube Consulting, specifically for working professionals preparing for Certified Anti-Money Laundering Specialist exam. We have 1,700 practice questions. They are scenario-based, exam-style, and built to match the difficulty and format of the actual exam, not textbook recall. We have concise study notes, written specifically for working professionals. No filler content. Only the key concepts, regulatory frameworks, and exam-relevant definitions you need to retain and apply. And we have a full e-learning course on CourseBox with an AI bot trained specifically on exam material. You can ask it questions at any time, test your understanding, and get instant feedback at 11 p.m. after a long day at work, on a weekend, whenever you have time to study. This is not personal coaching. It is a self-service system built for people who are serious about the exam and do not have time to waste. AdviseCube Consulting contact details are provided below should you need any support from us.
That is Domain A. All of it, from the financial crime spectrum to the 3-stage model, predicate offenses, high-risk sectors, VASPs, the travel rule, gatekeepers, and a structured study approach. If this video was useful, please like it. It tells YouTube this content is worth sharing, and it helps more candidates find it. Subscribe to the Financial Crime Awareness Hub. Domain B is next. Global AML and CFT frameworks, FATF recommendations, and how international regulation actually connects to your daily compliance work. Leave a comment. What sector do you work in, and which part of Domain A do you find most challenging? I read every comment. And if you are ready to start practicing, visit advisecubeconsulting.com. I will see you in the next video.